Hello and welcome to Hilltop Wealth Advisors Economic and Market Update for the second quarter of 2019. I'm David Wise, and with me today is Rusty Erickson.
Great to be here, David.
Thanks for joining me. So let's jump in. We've seen a really nice rally to start the year, Rusty. International and U.S. stocks are up double digits. The fixed income market looks to be poised to do well on the other end. But I think what's on all of our clients' mind is what's changed since the fourth quarter.
Yeah, fourth quarter of 2018, we saw a lot of volatility, and so far year to date, we've seen a really nice recovery in almost every part of the equity market, U.S. and international. And I think by and large, we feel like that's because the data are better. So, if we take a look within the U.S., we see really strong first quarter GDP ahead of expectations, even though we did have the government shut down for a bit there. And we also see very low unemployment. Those numbers kind of continue to improve, and that's really critical for the U.S. economy, right? About 2/3 to 70% of our economy is driven by consumer spending, right? Folks going out there and buying clothes and going out to eat and cars and houses and all the things that we do. And so more people working and more people earning money is certainly a strong thing. I think one of the concerns we saw kind of coming to the forefront in 2018 was about inflationary concerns, right? That in particular, if we saw unemployment remaining low, would that lead to wage inflation, which would then spill over to maybe some inflation in services and goods as well, and that kind of lead to more inflation within our economy. But we really haven't seen that so far.
Yeah, absolutely. And the Fed's response to that is there's no real need to bump interest rates up going forward. They had an aggressive stance, and now they're taking this prolonged pause, looking at the data, and kind of holding off on any future rate increases, and we could see a decrease.
That's right. I think with that change in monetary policy, that's been very supportive of the market here in the U.S. as well. And I think it's also been helpful for international markets too. The dollar stabilized, which has been, I think, very good for those emerging and developed economies throughout the world. And also for them, we've seen their markets improve this year, and I think part of that too is also that the data are better, right? Better than expected. And then I think from a kind of a geopolitical government perspective, we also see a little bit of easing of trade tensions. We still have a little bit to go on that, but I think that that's been supportive of those markets as well.
Absolutely. If we can get a trade deal done, there's still some momentum, especially on the international and emerging market side of the equation.
Absolutely. And so given kind of the very different market events we've seen at the end of last year versus the beginning of this year, what kind of conversations are you having with clients these days, David?
Well, I think it's all about risk. Are they comfortable with the current risk in their portfolio? Do they understand the downside? And December was a really good measure of that. Because we have the tale of really two different markets from the fourth quarter to now. And with that, the market dropped in December almost 20% from its high, and it's rebounded quite nicely, up over 13%. That's a 33% swing collectively, and that's pretty big.
That is a big swing, and I think that can really impact how we feel about our investments. When we look at that December statement, that can be pretty stark for some folks. But I think it's always helpful to remember that even during periods where we do see the market go up, there are typically these kind of punctuated time periods where the market is down, right? That's part of the reality of being an investor.
Yeah, and to better illustrate that, we wanted to share a chart with you that takes the stock market, the U.S. stock market, all the way back to 1980, and the tail of the tape there. And you can see in the gray bars, that's the year-end percentage of the U.S. market, and the red dots are actually the intra-year decline. So in any given year, on average, the market dips about 10%, but 29 out of those 39 years, the market is actually positive, which is about a 75% chance of making money in any given year.
And that's a pretty good batting average, right? And I think one thing that we've been certainly talking a lot with clients about is now's a good time to be taking those profits, looking to refill some carve-out buckets, make sure they're on track for their goals, just given where things are now compared to maybe where they were a couple months ago.
Absolutely. And I think that's really been helpful to have those conversations and the awareness, and it sets expectations.
Absolutely. And I think for us, when we're doing our planning, we're always wanting to make sure that what we develop in the plan and we set as goals matches how they're invested, right? And we think that those things need to be congruent, but also we know that all of our clients have a little bit different approach towards risk and how they feel about volatility, and so it's always helpful to be checking in on that. And I think these last couple months have been a really good time to kind of touch base on those very critical points.
Absolutely.
Well, thank you so much, David, for joining me here, and thank you all for watching. We hope you've enjoyed this and learned a little bit as well. As always, we're happy to speak with you, and if you'd like some more information, you can certainly check out our website and also read the Hilltop Views blog.
Thank you. Have a good day.